Every account in Canada is built for a specific purpose, whether that's tax deferral, whether that's just straight tax-free growth, or holding pension assets from a previous employer. Today, we're going to explore all of these accounts and when you might commonly use them. Let's start with the TFSA. This is one of the most well-used, well-known accounts in Canada. After tax dollars go in, leave it for compound growth through time, and the money comes out also tax-free. You don't want this sitting just as another savings account. That is a lot of potential that is just being wasted. This is best used for if you know that you don't have as high an income as you expect in the future, or your other registered accounts are already topped up. The amazing thing about the TFSA is that if it is largely untouched, it turns into a wonderful, almost estate account where you can leave your loved ones a tax-free gift at the end of time. And if you need to withdraw from the account, again, tax-free nature means that it is not affecting any of your government benefits. To the RSP, Registered Retirement Savings Plan. This is primarily a tax planning tool. In years of high income or a high taxable event like a sale, contributions are tax deductible, and so they can help that tax bill when you need it the most. I know, I'm in all the forums, I watch YouTube content myself. I understand that the comments are very polarizing coming to RSPs. Comments over and over again talk about how they want to get out of the RSP. What do I do with this RSP now that I have it set up? I want the dollars back, but I'm going to get penalized on the tax. And the number one rule when it comes to RSP is that only use it if you need it for tax purposes. Otherwise, there's plenty of other accounts that money should go towards. Spousal RSP, very similar to an RSP, beside the fact that it is the higher income spouse that contributes to it and gets the tax deduction for it, and the lower income spouse is the one that withdraws it through time. This is meant to smooth the household income level through time. Next up is the LIRA, Locked-In Retirement Account. This account serves a very unique purpose. It is only there to house those pension funds that you've accumulated at a previous employer. There are a lot of strings attached with LIRAs, and they fluctuate province by province. But essentially, they are trying to be a holding tank for those dollars until you approach retirement, when you can start drawing them out. Next, we'll talk about a variety of income funds, whether that is the Retirement Income Fund, the RRIF, the Spousal RRIF, or the Life Income Fund, the LIF. All do very similar things, slightly differently. So the RRIF, that is your typical retirement account where you can convert at any age, but you must convert by the end of the year that you turn age 71. It forces some amount of income out to your hands year after year, but you can have more flexibility with how those dollars come out to you. The Spousal RRIF is very similar. But remember, those contributions came from the higher income earner and now are getting drawn out by the lower income earning spouse. A Life Income Fund, or LIF, is very similar to a Retirement Income Fund, or a RRIF. The difference being is that these are employer dollars that they had set aside for your retirement. And so, in addition to the minimum, there's also a maximum amount of income that can flow out to you. Therefore, it is inherently less flexible than the RRIF. The non-registered account goes by many names: cash account, open account, taxable account. They all mean the same thing. Once we've optimized the RSPs, the TFSAs, the registered accounts that are available to you for your situation, any excess or spillover can be invested in the non-registered structure to give you the ultimate flexibility, as it can be tailored for income or long-term growth, meaning that it is one of the most powerful tools available to you. Our DSP, Registered Disability Savings Plan, one of the most effective ways to save for someone's retirement if they qualify for the disability tax credit. The amount of grants and the amount of matching is unlike any other account that you have access to. There are a lot of rules that apply to RDSPs, and so if you are looking to open one up, please consult with a professional. The FHSA, First Home Savers Account, fairly new account in the Canadian landscape, and it is one that has a lot of different applications and not a whole lot of downsides. You get tax deduction on the way in, making it work kind of like an RRSP, and if you use it for a qualified first home purchase, you get to use those dollars tax-free, kind of like a TFSA. And if you don't end up using those dollars for whatever reason, you can roll them into your RSP. And so you don't have to give any of the deductions back. So if you are looking to save for a first home or looking to help a grandchild, this is a great account to look into. RRSP, Registered Education Savings Plan, this account is phenomenal if you are trying to set up an education savings objective. You get 20% matching on the dollars on their way in, and that tax-deferred growth through time, and on withdrawal, that gets taxed to the student going to school. A lot of our clients, again, we're dealing with Canadian retirees, their kids are out of school, but they're looking towards grandchildren. And one of the best ways to do this with how messy the RRSP structure in the back end actually is, talk to the parents, understand if there is an RRSP already set up, and give them money to deposit there. So that's just a quick look at the laundry list of accounts that the average Canadian retiree has available to them. What do you think? Did you learn a little something from today's video? Hit the subscribe button, click the bell icon so you never miss another Pellegrini Financial video. Thanks for stopping by.